welcome to the Morningstar series Why Should I Invest With You? I'm Emma Wall and I'm joined today by Hugh Yarrow, co-manager of the Evennote Income Fund. Hi Hugh.
Hi Emma.
So you wrote a piece for us in December and the tone was surprisingly pessimistic in the outlook for dividends. It was going to be that you can still find dividend paying stocks, but unfortunately it's going to be lower dividend growth and lower dividends overall for 2016. So far that's proved true, hasn't it?
Yeah, there's obviously some very specific issues in particularly the commodity and energy sectors, which is dragging on the overall dividend outlook for the UK. But I think more generally, economic growth is slow and has been slow since 2008 downturn. And corporations, whoever they are, even resilient businesses, are finding it more difficult to generate top-line growth, and that does mean a more modest outlook for dividends. I think another sort of specific point over the last couple of years has been that sterling has been relatively strong, particularly against non-dollar global currencies, and that clearly provides a headwind for multinational companies listed in the UK that earn their money overseas and then it's reported back into sterling.
You mentioned commodity stocks there. Of course, dividend cuts lag loss of profit, and so we probably expect to see some more commodity stocks losing their dividend over the course of this year. However, for those that still have, they're looking pretty attractive yields. We're seeing sort of Anglo American at 15%, BHP Billiton at 12%, Glencore at 11%. I know you've said in the past, be wary of high-yielding stocks, but surely there's got to come a point where you think, actually, the valuations on these are so compelling, we can't ignore them.
Well, our process is to focus on asset-light businesses that have strong intangible assets and that generate a high return on invested capital. So we don't actually invest in the commodity and oil-producing stocks at all. So we leave that to other people. I mean, the stocks you mentioned there, actually Anglos and Glencore have both announced cancellations of the dividend already. So those headline yields are effectively going to disappear within the next few months. But I would make a more general point that in the current sort of sentiment, which is becoming increasingly negative, there are some more interesting opportunities emerging. I think for us, a couple of things to focus on in terms of dividend sustainability and the potential for growth is, firstly, high and sustainable free cash flow. You know, cash flow is what's left in the till at the end of the year and what pays the dividends. And we like repeat purchase business models, whether that's from subscriptions in software or media businesses, or whether that's selling soap or shampoo or toothpaste. And then also looking at balance sheets, and that's absolutely crucial. And we're particularly wary of more economically sensitive businesses that have debt on their balance sheets, because often in a downturn, that is where dividend cuts, as you're currently seeing in the commodity sector, come from.
And that leads us to where you are investing at the moment. You have a big overweight in consumer stocks. I mean, is this something that that you see continuing to play? Are these a sort of buy and hold forever type investments?
They're not buy and hold forever. We do have a valuation-based approach, but these are fantastically high-quality companies with very strong and sustainable and stable free cash flow. And I think in the current market, investors are being reminded of those qualities. The consumer branded goods exposure that we have, we still think offers good value, particularly on a quality and risk-adjusted basis over the long term. But I would also point out that there are some other interesting opportunities emerging in other areas, and if that trend continues in the market, then we may well use those positions as a source of cash and trim them back to invest in other opportunities that are emerging. And
what are those opportunities that are emerging?
Well, I'd particularly point out the sort of smaller companies sector in the UK, which has been a fantastically strong place for performance over the last 5 or 6 years. And when we launched the fund 6 years ago, we had a large exposure to smaller companies, but due to valuations, we increasingly reduced that. But in the last few months, you're starting to see selectively some opportunities re-emerge, very high quality businesses which have very strong balance sheets, very strong free cash flow, and good potential for dividend growth. So that's an area that we think is becoming increasingly interesting now.
Hugh, thank you very much.
Thank you.
This is Emma Wall from Morningstar. Thank you for watching.